Listen up, folks. Today, we're diving into the world of investments. Investing is not a spectator sport. It's an active journey that requires your participation and commitment. You gotta get in the game to win. But where to start? The world of investments can be overwhelming, especially for beginners. Two popular options are mutual funds and exchange-traded funds, or ETFs. These are great starting points for anyone looking to grow their wealth. Let's break it down. Mutual funds are like baskets of stocks, bonds, or other assets. They offer a way to invest in a diversified portfolio without having to pick individual stocks or bonds yourself. Mutual funds pool money from multiple investors to buy these assets. They pool money from multiple investors to buy these assets. This collective investment approach allows for greater purchasing power and diversification. Think of it like a giant investment club where everyone chips in to buy a variety of investments. A professional fund manager decides what goes in the basket. This expert management can help optimize returns and manage risks. ETFs are also baskets of assets, but they trade on stock exchanges like individual stocks. This means you can buy and sell them throughout the trading day. They're like mutual funds on steroids, offering more flexibility. ETFs can be a great option for those who want the benefits of mutual funds, but with the ability to trade like stocks. Both mutual funds and ETFs can help you diversify your portfolio. Diversification is crucial because it spreads your investments across different assets, reducing risk. This means not putting all your eggs in one basket. By diversifying, you protect yourself from the poor performance of a single investment. Remember, diversification is key to mitigating risk. It's one of the fundamental principles of investing and can help you achieve more stable returns over time. Now, let's get down to business. Today, we're diving into the world of investments, specifically focusing on mutual funds and ETFs. These two investment vehicles are popular choices for both novice and seasoned investors, but they come with their own sets of advantages and disadvantages. Mutual funds and ETFs have some key differences that can significantly impact your investment strategy and returns. It's essential to understand these differences to make informed decisions. Understanding these is crucial before you throw your hard-earned money at them. Making the wrong choice could lead to unnecessary fees, lower returns, and missed opportunities. Mutual funds can be actively managed or passively managed. Active management involves a team of professionals making decisions about how to allocate assets within the fund. Active managers try to beat the market. Think of them as stock-picking cowboys, always on the lookout for the next big opportunity. They aim to outperform market indices through strategic buying and selling. Passive funds, on the other hand, track a specific market index, like the S&P 500. They're more like autopilot, aiming to replicate the performance of the index they follow with minimal intervention. ETFs, on the other hand, are mostly passively managed. They are designed to track the performance of a specific index, sector, or commodity, offering a straightforward way to invest in a broad market segment. Mutual funds often have higher expense ratios than ETFs. These expense ratios cover the costs of management, administration, and other operational expenses. These are annual fees charged by the fund. Over time, these fees can add up, significantly impacting your overall returns. Don't underestimate these fees. They can eat into your returns over time. Even a small difference in expense ratios can lead to substantial differences in your investment's growth over the long term. ETFs trade throughout the day like stocks. This means you can buy and sell them at any point during market hours, giving you more flexibility and control over your investments. You can buy and sell them anytime the market is open. This intraday trading capability can be particularly advantageous in volatile markets, allowing you to react quickly to market changes. Mutual fund prices are calculated only once a day, at the end of the trading day. This means you buy or sell at the net asset value, NAV, determined at the market's close. You buy or sell at that price, no matter what happens during the day. This can be a disadvantage if the market moves significantly during the trading day. Mutual funds often have higher minimum investment requirements than ETFs. This can be a barrier for new investors with limited capital, making it harder to diversify their portfolios. This can be a barrier for new investors with limited capital. ETFs, on the other hand, often have lower minimums, making them more accessible to a broader range of investors. Generally, ETFs are more tax-efficient than mutual funds. This is because of their unique structure, which allows for in-kind redemptions, minimizing capital gains distributions. We'll delve deeper into this later. Understanding the tax implications of your investments is crucial for maximizing your after-tax returns. Mutual funds have been around for ages. They're like the seasoned veterans of the investment world. But are they right for you? Let's weigh the pros and cons. Mutual funds offer instant diversification. Active funds come with a dedicated fund manager. Buying and selling is relatively straightforward. Those pesky expense ratios can eat into your profits. You have no say in the individual securities the fund manager picks. Capital gains distributions can be a real pain come tax time. Mutual funds can be a good option for hands-off investors, but be aware of the fees and potential tax implications. Section 4. ETFs. Shining armor or fool's gold. ETFs are the new kids on the block. They've gained immense popularity in recent years. But are they all they're cracked up to be? Pros: lower fees. ETFs generally have lower expense ratios than mutual funds. Trading flexibility. Trade them anytime during market hours, just like stocks. Tax efficiency. ETFs are typically more tax efficient than mutual funds. Cons: trading costs. You'll incur trading commissions when you buy or sell ETFs. May not be as diversified. Some ETFs can be narrowly focused on specific sectors. ETFs offer flexibility, lower costs, and tax advantages. They're ideal for active traders and investors seeking specific exposures. Section 5. Choosing your champion. Finding the right fit for you. So which one is right for you? This is a question that many investors grapple with, and the answer isn't always straightforward. The answer, my friend, is not so simple. It requires a deep dive into your personal financial situation and future aspirations. It depends on your individual needs and circumstances. Everyone's financial journey is unique, and what works for one person might not work for another. Investment goals. What are you saving for? Retirement? Perhaps you're looking to build a nest egg that will support you in your golden years. A down payment on a house? Maybe you're dreaming of owning your own home and need to save up for that initial investment. Your investment strategy will differ depending on your goals. Each goal requires a tailored approach to ensure you reach it efficiently and effectively. Budget. How much money do you have to invest? Your available funds will significantly influence your investment choices. Remember, mutual funds often have higher minimum investments. This means you need to be prepared to commit a certain amount upfront. Risk tolerance. Are you a risk taker, or do you prefer to play it safe? Understanding your comfort level with risk is crucial. Your risk tolerance should align with your investment choices. If you're not comfortable with high risk, you might want to consider more conservative options. Trading flexibility. Do you want the ability to trade throughout the day, taking advantage of market fluctuations, or are you comfortable with once-a-day pricing? Some investments offer more flexibility than others, and it's important to choose one that matches your trading style. Tax considerations. Don't forget about Uncle Sam. Taxes can eat into your returns if you're not careful. Factor in the tax implications of your investment choices. Different investments are taxed in different ways, and understanding this can help you maximize your returns. In conclusion, finding the right fit for your investments requires careful consideration of your goals, budget, risk tolerance, trading flexibility, and tax implications. Take the time to evaluate each aspect thoroughly, and don't hesitate to seek professional advice if needed. Your financial future depends on the choices you make today. Section 6. When to buy, when to hold. Real-world scenarios. Let's look at some real-world scenarios to see when you might choose one over the other. Scenario 1. Sarah, the beginner investor. Sarah is just starting to invest. She has a small amount to invest and is looking for a diversified portfolio. An ETF tracking the S&P 500 would be a great option for her. Scenario 2. John, the retirement planner. John is saving for retirement and wants a diversified portfolio with professional management. He chooses a target date retirement fund, a type of mutual fund. Scenario 3. Emily, the active trader. Emily likes to buy and sell frequently based on market movements. She prefers ETFs for their trading flexibility and lower costs. Section 7. The bottom line, your money, your choice. Remember, there's no one-size-fits-all answer. The best choice for you depends on your individual circumstances. Both mutual funds and ETFs can be valuable tools for building a diversified portfolio and achieving your financial goals. Do your homework. Understand the fees, risks, and tax implications. And don't be afraid to seek professional advice. After all, this is your money we're talking about. Now go out there and start investing.